So last month, Finance Minister Nirmala Sitharaman had announced the merger of 10 state-run banks overnight into 4. It's been about 1 week and we have spoken to a host of banking industry participants to understand what does this really mean for the banking industry and the economy going forward. And over the course of the couple of minutes, we will try to explain to you the ramifications of the move that this government has done. First, let's begin with the theme. So what exactly was the theme behind the merger? Remember, a couple of months ago, the government merged Bank of Baroda, Dena Bank and Vijaya Bank into one bank. And the learnings were clear that there was a big issue with technology when it came to merging those banks, and the government went with the technology platform. So all these banks which have been merged together have similar technology, though they are on different platforms. So technology was the biggest theme. The other theme was capital. Since 2015, the government has infused about over 3 lakh crore in state-run banks, and if you exclude SBI and if you look at their market cap right now, which is 5 years hence, you will find out that their market cap is even lesser than 3 lakh crores. So it's even lesser than the capital that the government infused. So in terms of equity returns to the shareholder, it has been actually negative. So what they have done is they have merged these banks and they have given upfront capital of about 55,000 crore. That brings the tier 1 capital, the CET ratio of these banks to closer to 10% over the regulatory requirement of 8%. So that is what they have gone with. Two themes: technology and capital. What is the government trying to do by create these large size big banks? So they will be larger and they will be faster. So they are building economies of scale. What it does is, look at SBI. It has a balance sheet of 24 lakh crore. It is a much more nimbler bank. The money that is coming from the government is infused and consumed in a much better manner. If you're investing in technology, the investment that you make happens in the right way. So what you're doing is you're creating larger and faster banks. What it does for bad loan resolution is, remember, at one point of time, India had 27 state-run banks. Now it has 12 banks. So the decision-making process becomes so much more easier. You don't have to run to 27 bank managements to seek their approval. Now you have to seek approval from only 12. This also applies to the loan disbursals. If you are working on large value loans, say for example 25,000 crore of city gas project, and there are multiple consortium bank involved, then getting approvals from 12 banks, which will be much more easier than getting approvals from 25 banks. If you also look at the government, imagine the Department of Financial Services getting running after these 27 state-run banks to get them into order. Now it will be so much more easier for them to run after 12 banks rather than 27. There will also be merger banks. Every merger is a messy affair. History has shown that. The latest being that we saw with Bank of Baroda. Prior to that, we saw SBI merging 5 subsidiaries and 1 Bharatiya Mahila Bank. So all these mergers were a messy affair. Two big issues that really come from the merger is the data mergers. So what happens is that you have common sets of clients and common sets of customers. So you have to merge that. What happens is that, especially for the entity which is getting merged, it's generally a tendency that because the anchor bank, which is the main bank which is merging the other banks, there will be an issue with customers fleeing the anchor bank. There is always a concern that their concerns won't be catered to. So that is what the anchor bank should be careful about. The second obviously is when state-run banks are in the picture, it's related to the unions. So there is a big issue with people and culture. So that is the second point which these banks have to be very careful about. And history has shown with Bank of Baroda and State Bank of India, there has been a number of voluntary retirements that these banks had to go through. But on the positive side, what this really does is it fills talent. Earlier we had 27 public sector banks. Imagine the exercise to finding top management and CEOs for these 27 public sector banks. Now they just have to find the top talent for 12 banks. So it will be much more better pool of talent will be available across banks, and even in mid management, which has been the biggest concern in public sector banks, a larger pool of employees will help fill these goals. So these are the clear takeaways from the larger and faster banks that the government is trying to create. Outside the merger, the government also unveiled a host of reforms that you must have read about in the past 1 week. But the industry is really calling for a couple of more reforms, which the PG Naik panel had really worked about 5 years ago in 2014 when the report was released. It's more thrust on governance, better boards, because remember, the control is still the Department of Financial Services, and just by appointing people on the board, that doesn't mean that you are unveiling good governance norms. So that is one more reform that the public sector system is waiting for. The second obviously is incentives and rewards. We very well know that public sector employees are not paid as much as private sector employees, so there is clearly a need for incentivizing them on par with the market. Also, what they are also seeking is allowing a more better talent to come in. So if you incentivize them, you will get a better pool of resources available. So that is what the market is hoping for. The other big issue is building strategies. If you've seen, almost all the state-run banks you go to, they are clones of each other, and that is a debate which even former Reserve Bank of Governor Raghuram Rajan had raised at one point of time, that if you enter a branch, they all look similar and clones of each other, so they don't have strategies. So by making these big banks, the government really wants them to have strategies. Right now they are just duplicates of each other. So what really the focus should be for these banks is to look at geographies, synergies, niche areas that they want to focus, and that will really help building strategies and not being clones of each other. The last point which the government really talks about is phone banking, which is that the UPA2 government is often blamed for calling banks and getting priority for corporate loans, which have now turned bad. But what has been seen in our discussions with bankers of late is that we have seen the government and the RBI forcing banks to go ahead and link external benchmark to loans nowhere in the world. Not a single regulatory authority issues any regulations regarding to pricing of retail loans or corporate loans. So India is the only market which does that. So that is a big issue. And also we have seen a major thrust on loans to MSMEs and mudra loans. If this is not phone banking, what is? So the government has to really demarcate as to its level of interference, because obviously there are social causes that it wants to cater to, and it should also question whether time is right to let go of the kind of equity that it holds in these banks. It holds almost 90 to 95% in some banks, and does it really need to hold so much equity in banks which look all the same? And that's a question that the government has to ask itself.